I will start with a brief introduction of our team. I am Atresa Roberts, partner and COO here at Curo Private Wealth. I am joined by partner and CEO Ann McCabe, also by our director and financial advisor Jane DiVincenzo, Xander Cochran, our very esteemed investment and planning associate, Carol Castillo, financial advisor in our Reston office, and then a new face who has joined the committee, introducing Nihad Basic, financial advisor now here working in the Rockville office. So thank you again so much for joining us. So we will begin this update, as we do often with our updates here. And it's just with a quick review of 2026 so far. So economic growth remained resilient-ish, is what I will say. GDP growth actually ended in the first quarter of this year at about 2.1%, fueled by AI tech and infrastructure investment. In addition to some resilient consumer spending, we have actually just seen reports for the second quarter showing that growth has slowed as of June to about 1.5%. Inflation peaked, the headline CPI inflation, which includes volatile oil and energy prices, peaked at 4.2% in May. The consumer price index decreased, however, in June by 0.4%, marking the largest one-month decline since April of 2020. In the second quarter, we also experienced a huge rally in the S&P 500 or in U.S. stocks. As you may remember, military strikes by the U.S. and Israel against Iran started at the end of February in the first quarter, triggering a market sell-off during the month of March. So if you watched our presentation from the first quarter, we would have noted that total market return at the end of Q1 was actually down about 4.3%. The S&P 500 has finished the first half of the year, ending the second quarter, with positive total return of 10.2%. We have also seen this growth fueled by strong projected corporate earnings, which is really providing a tailwind for U.S. stocks going into the second half of the year. We'll now switch over to a review of our economic dashboard, and very quickly just noting where this dashboard stood at the end of the first quarter, and then switching over to where we are now as of the end of Q2. So we can see that 3 of those 5 indicators remain in neutral territory, with monetary policy shifting slightly more negative. Now, in your review meetings or in our updates at the end of 2025, we talked about the market pricing in potential rate cuts in 2026, how quickly things have changed. So higher energy prices, along with some sticky inflation, have shifted the Federal Reserve to a more neutral stance. The actual meeting of the FOMC ended yesterday, July 29th, if you're watching a recording of this, and the FOMC did vote to continue the pause in rates. The market is actually now pricing in some rate hikes for 2026, which we will go into in a little bit more detail later. Manufacturing did shift into positive territory this year and actually continues to strengthen. The ISM manufacturing PMI, which is the monthly indicator that is measuring the health of the manufacturing sector in the US, read above 50 in the first 2 quarters of the year, which signals expansion in that sector, which has been a nice change that we've seen since the pandemic. Consumer and housing remain relatively unchanged. Rising inflation has led to higher everyday cost for the average American, which has also contributed to record lows in consumer confidence this year. Consumer spending, however, has remained resilient. We continue to go out and shop and buy, well, at least some of us. Elevated mortgages has also softened, elevated mortgage rates have also softened buyer demand. And then we've also seen some softening in the labor market. Now, unemployment has remained steady between about 4.1 and 4.3%, which is below historical 30-year averages. So now to go into a little bit more detail about our economic review, I'm going to turn the presentation over to my colleague, Xander.
All right. So first, starting off, wanted to look at one of the biggest determining factors we've seen so far this year, which has been around oil. We've seen on the left side here of the chart, historically, the price for 1 barrel of Brent crude oil prices going back to 1970. And you can see historically, there have been many shocks over the years for many different reasons. And recently, this year, we have seen an additional shock with everything going on in the Middle East this year. If you zoom in for the red portion of that box, and then that's showing on the right side, zoomed in for the past year and a half, you can see that recently in Q1, the price for Brent crude oil rose nearly 80% with everything going on in the Middle East. But perhaps just even more surprisingly is how quickly that has come down since then, at least through the end of June this year, which this chart is showing. Since then, in the month of July, we have seen prices rebound a little bit, but seeing those prices be very volatile in terms of what's going on is affecting the economy. Of course, it's affecting gasoline prices, it's affecting travel and flight prices, and inflation overall. So moving next slide, we see the effects of inflation. And inflation continues to be a challenging area for the economy overall. We do see that headline CPI inflation peaked at 4.2% in May of this year. And then for the month of June, it came down to 3.5%. So it does appear that inflation has at least peaked and heading directionally lower, but it still remains very high relative to the Fed's 2% target of what they're shooting for longer-term inflation. And we have not seen that 2% target for some amount of time since pre-COVID was the last time we saw those lower numbers. And so that's definitely creating a headwind and a challenge for consumers as people have to eat the higher prices. If you go to the gas pump, although it's come down a little bit, it's still elevated relative to more recent norms of having to eat that, and that's hurting consumers' budgets a little bit, also affecting the price of, or affecting businesses as their goods prices are moving higher as well. One thing regarding the Federal Reserve is looking at inflation as a big part of their mandate, one of the big two parts of their mandate. So switching to the next slide, we can see with interest rates for the federal funds rate that the Federal Reserve has control over. What this is showing is the current Fed funds rate minus the expected year-end rate for 2026. Going back historically, that change over the past 12 months. So if you go back to where we sat in June of 2025, markets were expecting roughly 5 cuts by the end of 2026. Now, a year later, we stand in June 2026. By the end of this year, it's likely that we could see 1 or 2 hikes instead of cuts by the end of this year. Now, as Teresa mentioned, we saw the Fed come out yesterday with their decision to hold interest rates. The new Fed chair, Kevin Warsh, has made it clear in his speeches and rhetoric that he is in favor of being harsh on inflation and getting to that 2% target. However, we did not see a hike that would make that go faster. So that's something that's causing the markets to react a little bit more, where we see the longer end of the yield curve move up a little bit higher, even though the short end that the Fed controls sat stationary for the past bit. And next, just looking into one of the positive developments that we've seen is manufacturing activity. So as Teresa mentioned, the ISM manufacturing index has moved higher over the past couple of quarters after being in below the 50 mark for the past few years. So seeing this development is definitely promising. It's good for industrials, which is one area that we are a little bit overweight in many of our portfolios. That Anne will get to details a little bit later on. And that's one of the things there. This is not only for the US, but we're seeing that this broader globally in many other countries where manufacturing levels have been higher into expansionary territory, which is good for the economy. And then next we see on the consumer side. So we definitely do have the consumer coming out when it comes to consumer confidence. People don't feel great about the economy right now. They don't feel great about their financial picture looking forward a bit. But if you look at the numbers of actual spending, this is one area that surprises a little bit if you see recent developments where real retail spending, so that means it is adjusted for inflation. So even despite the fact that we have higher inflation this year, that's moved higher, and that number right now is approaching 4%. So rather strong retail spending. This is also excluding autos, which can be kind of a one-off bigger purchase that is cyclical. So that is also taken out of there as well. But overall picture, you see in aggregate people going out and spending despite maybe complaining about things going, prices moving higher or the economy not doing as well overall. And then one other thing talking about the consumer as well is looking at households and how they feel about their debt situation. So it's one thing to get a survey and say, I feel great about the economy, I feel terrible about the economy. There's another survey that comes out that shows a little bit more pointed question. So this is data looking at asking the question, what is the chance, do you think, of missing a minimum debt payment over the next 3 months? So those who are a little bit more challenging or have a higher financial strain are concerned about missing a debt payment. We could see that data would show up here. Since COVID, that number had been relatively low. Just as after COVID, there was very low interest rates on debt. We also had a lot of stimulus that was helping the economy. And then over the past 6 years, this percentage has moved higher until recently. So earlier at the end of last year, we saw about a 14% rate of percent of respondents saying that they were worried about missing a minimum debt payment in the next 3 months. More recently, that's fallen to about 12%. So we hear a lot also about a K-shaped economy, where those at the higher end are doing well, those at the lower end are doing worse. But it seems like those at the lower end who may have some financial strain, not so much that they're doing worse, but it's more of they're kind of treading water and just not doing quite as well as those at the higher end of income earners. But overall, it does suggest that another data point that consumption and spending could remain stronger for the second half of this year. Last thing that also matters for how much a consumer can spend, of course, is whether they are employed and have that income. So with that, I'll switch gears over to Nihad to talk a little bit about the labor market.
Thank you, Xander. Yeah, so we'll take a look at the labor market here. Looking at the overall labor market, the number of jobs added or lost in the U.S. economy each month is on that left graph there. We've seen a reversal of kind of a downward trend in recent years. There's been a positive uptick as of late. Job growth slowed considerably late last year, but improved modestly in recent months. So we are seeing some positive results for now. Over the past 3 months, we've seen an average of about 111,000 jobs created per month. June specifically, as you can see there in blue, had 57,000 jobs created. Generally, we like to see somewhere between 100 and 150,000 creations per month, and that's considered sufficient. And the asterisk here is that there could be revisions at a later point in time, leading to potentially lower numbers, but the overall recent trend has been rather positive. As for the chart to the right, outlining the last 30 years wage growth and unemployment rate, we've seen wage growth right at that 30-year average at 3.4%. So rather neutral territory right now. There are still, concerns surrounding the labor demand in certain white-collar industries where automation and AI may be contributing to slower hiring, but unemployment has ticked down to 4.2%, which is sizably below that 30-year average. And we can go over to the next slide. This is a rather interesting slide looking at the growth by sector, by specific sectors, job growth by sector. And we've seen overall job growth in the past year. The majority of it has been through education and health services, so it's rather concentrated. And you'll see a lot of kind of 215,000 in a employment reduction on the government end. A lot of that may have to do with the Department of Government Efficiency. And then in addition to that, you also have the information and financial activities sectors greatly affected. Again, you can see kind of a narrative here that the sector is kind of more exposed to AI with information and financial activities where jobs are more scalable, have definitely we see the narrative that they may have been affected by the developments and the rapid growth of artificial intelligence. And we can go over to slide 13. This is, again, very interesting slides because it's showing us the average headline tariff rate, which is more of a general rate, the ones you'll see kind of in the news. And depending on by the color of the bars you're seeing, it'll be where, what law is enacting that specific tariff. So the chart reflects a reduction in the IEEPA-related tariffs following legal challenges and court rulings, although ultimately the policy path remains subject to appeal and further action. But the refunds of the IEEPA tariffs have been coming in, and as those have been coming in, the Trump administration has been deploying new temporary tariffs, as you can see with the purple. Those are the Section 122 tariffs. They are kind of a stopgap, and they last for 150 days. But once those are projected to fall off, expire, they're going to have additional methods of raising tariffs to what seems to be kind of a target rate. You have the Section 301 labor practice tariffs. Those, as you can see, are projected to go up and kind of offset the Section 122 tariffs that will eventually be gone. And like I said, what you're essentially seeing is the use of different laws to deploy kind of a target tariff rate or a higher tariff rate from the administration. This trend seems to be continuing for several months. And current market expectations do not point to a significant reduction in tariff levels in the near term. We know that there's a November federal election happening soon, but many trade restrictions, at least historically, have remained in place across administrations of both parties. So the bigger impact would likely be on future expansions and political environment surrounding them. Now I'm going over to the market review with Carol Castillo. Thank you.
Yeah, so now we're digging into a little more specific into the market review. So on this slide, which we've seen frequently, we'd like to take a look at what the market has been doing for the first half of the year. Performance has been surprisingly well on the equity side. We've had strong returns, especially driven in the second quarter by corporate earnings. The US at 10.2%, emerging markets at 24%, and international at 9.6%. Fixed income has been relatively flat this year as investors continue to monitor, of course, interest rates and economic conditions. And the real assets have both done very well. Commodities at 14.4%, supported primarily by energy sector and higher oil prices. And real estate at 17.6%, benefiting from strong operating results across REITs and a growing demand in data centers and lodging. Now we will take a deeper dive into a few financial concepts of the S&P 500 that keep us up at night. The first one we're going to see through this next slide is market volatility, which has been a recurring theme in the past few years. We can see in the pink sector, which reflects 2025, when the announcement of the reciprocal tariffs led to a significant pullback in the market. However, the market decline fully recovered within 55 days, returning to the level it was at right before the announcement. In the yellow section, we see represented 2026, when markets reacted to the start of the Iran conflict. While the initial decline was similar, the recovery was even quicker. the market dropped back close to 9% and returned to its pre-drawdown level in just 11 days. So what we want to highlight here is that while market downturns can feel unsettling in the moment, history continues to show us that these periods of volatility often are temporary, and the market has proven remarkably resilient over the long term. In the next slide, we can take a look at stock valuations. And of course, this chart, what we're highlighting is the forward PE ratio, which measures how much investors are willing to pay today for each dollar of the company's expected future earnings. As of June 30th, the forward PE ratio stood at 20.4 times, compared to the 30-year average of 17.2 times. Now, while valuations are above their long-term average, we know that much of the returns, much of this is attributed to strong corporate earnings and continued confidence in future growth, which is what we've been talking about. Although stocks may appear somewhat expensive relative to historical averages, the current valuations do not suggest we're in bubble territory. Instead, they remain broadly supported by the underlying strength of company returns. Another aspect of the S&P 500 we'd like to take a look at is in the next slide, please, which is market index concentration. So we do hear about, the top 10 largest companies kind of pushing through the S&P 500 index. We'd like to look at this chart, again, highlighting the forward PE ratio of the top 10 companies. If we look at the left side of the screen, we see that the top 10 companies is currently at 21.6 times compared to their average, to the 19.6 times for the 490 companies that remain in the index. So really on the surface, the largest companies do appear somewhat more expensive. However, when we compare those valuations to their own historical averages over the past 30 years, it does look a little different. The top 10 companies are trading at around a 4% premium to their long-term average, while the remaining 490 companies are trading at a 23% premium. So in other words, while the largest companies are valued slightly higher than the rest of the index, their valuations are actually quite reasonably relative to their own 30-year history. On the right, we can see a little different analysis of the same information about market concentration. We see that the top 10 companies make up 37.9% of the S&P 500 market value. But it is important also to highlight that these same companies also generate 33.7% of the index earnings. So while concentration remains elevated historically, these companies are not simply benefiting from investor enthusiasm. They are earning their position through strong profitability and continue to be a major contributor to the index overall earnings growth. And the next slide, please. We are going to see what is happening with earnings growth, which has been a key theme, of course, even throughout this whole presentation. JP Morgan is currently forecasting the S&P 500 earnings to be at 24% for 2026. This is a significant increase from the 10 to 12% growth expectations we saw at the beginning of the year. The strong earnings momentum helps explain why U.S. stocks have continued to perform well despite the economic and geopolitical uncertainty we've experienced this year. We see a similar story when looking at profit margins, which is the graph on the right, which measures the percentage of revenue that companies get to keep after covering their expenses. Profit margins currently stand at 15.1%, which is the highest level since 2002. Strong earnings growth and record high profit margins suggest that companies are continuing to generate solid profits, which remains a key driver in market performance. Now I'll pass it over to Jane.
Thank you, Carol. I always enjoy talking about this. It's a question that comes up a lot. They ask us what our crystal ball says about markets, and our best guide is looking at historical patterns to get some feel for what the future might hold. Looking back over 76 years, you'll note that the second year of the presidential cycle historically has the lowest returns at 4.6%. In addition, historically, we've also had the highest volatility in year two of the cycle. And you can imagine why that is. We've got a lot of uncertainty with elections coming up soon. But it's interesting if you stay the course and stay invested, you're rewarded for your patience in year three. And you may have noted in some of the charts before when Carol pointed out about downturns, when there's an upturn, it's very quick and sharp. And because we don't have a crystal ball, we recommend investors stay in their allocations that we're recommending for each of their portfolios because those recoveries happen so quickly and suddenly. And in the next slide, another topic of interest with a lot of clients is, again, looking at patterns that we've seen going back to 1949, that under Democratic presidents, markets have actually outperformed in most scenarios. And interestingly, a divided Congress seems to give markets more confidence. And the theory that seems to be the most popular is that a divided Congress doesn't get as much done, pass as many new rules and legislative activity. So that gives investors more confidence that they're not standing on shifting sand and the markets will be more stabilized. So with that, I'd like to pass it to our esteemed colleague, Ann McCabe.
Thank you so much, Jane. So we have been talking now for about 29 minutes or so about what's been happening in the economy and in the markets. And the natural next question, I think, is what does this mean for your portfolio? So I am going to share how our investment committee is currently viewing the landscape and also review some recent changes that we have made to our portfolios that we manage. So as you can see, our investment committee has what we're calling a conditionally favorable view of the market and the economic environment. And if you have been following our updates for a while, you know that all last year in 2025, we had a cautiously optimistic view of the markets and the economy. And towards the beginning of this year, after I would say a pretty heated debate of our investment committee during one of our first meetings of the year, we did decide to slightly tweak that position to a conditionally favorable one. So not a huge change, but a little bit of a tweak. But what this means overall in plain English is that we are still very constructive on the markets and on the economy, especially because of a lot of the data that we have covered so far here with you today. And most notably, we would say the corporate earnings environment remain really strong. But we have seen quite a bit of gains this year, and there are also some big risks in the background that still exist. And we realize that conditions can change very rapidly, both to the upside as well as to the downside. So we wanted to take a slightly more balanced approach. So one of the changes that we've made is we have slightly reduced exposure to US large cap stocks and increased exposure to international stocks and a bit to bonds as well. So overall, you can see these are not dramatic changes. They're just a little bit of fine tuning of our portfolios. And our goal at the end of the day is to stay positioned for growth. We obviously want to maximize returns as much as possible, while also maintaining diversification and risk management inside of your portfolios. All right. So again, if you have tuned in before, you've seen this chart. This is one of our favorite charts because it reminds us of why we invest the way that we do. And as you can see in that quote box, while stocks can be one of the most volatile asset classes in the short run, history has shown us that they've been the most rewarding asset classes for long-term investors. And if you look across the last 200 plus years, we have experienced quite a bit of challenges. We've had wars, we've had inflation, political uncertainty, market crashes, and yet stocks have continued to create wealth over time in a way that other asset classes just simply haven't been able to match. And markets will always give us a reason in the short term to be worried. In the industry, we call that the market climbs the wall of worry. But if we stay invested in the long term, as many of us have mentioned so far on this webinar, it will be typically, historically anyway, powerful. And it's way more powerful to stay in the markets than it is to try to time the market. So one of our favorite quotes is, it's about being time in the market, not trying to time the market. So if you look at this chart, if you were here back in 1800 and you happened to invest $1 in the stock market, that dollar would have grown to almost $3 million. And this is adjusted for inflation, importantly. Had you taken that same dollar and put it in bonds, it would have grown to less than $1,400. If you put that dollar in like a high yield savings account type of vehicle, it would have grown to about 246. Gold would have gotten you $8. I know gold has been in the news a lot recently and has had good performance in the short run, but you can see what it's done over the long run. And then, of course, money under the mattress sort of thing. Inflation is going to eat away your purchasing power, and your dollar would have declined down to less than 4 cents. So, power of long-term investing there. All right. And to close out, as we always do, we love to share this visual of our philosophy here at Curo and how we work with our clients each and every day. The reason that we share these market and economic updates with you is to keep you informed, but it is not because we're trying to predict exactly what is going to happen next. We don't, unfortunately, have a crystal ball, and no one can really do that. Sadly, we wish we could. But one of the things that we try to coach clients through is to be really clear and identify what is inside of our sphere of control and what is outside of our control. And unfortunately, we can't control the volatility in the markets, the swings that we're going to experience on a daily basis. We can't control interest rates and what the Fed decides to do with policy or geopolitical risks or concerns. But what we can control is how we respond to all of these challenges. And where we come in is we help you build a thoughtful financial plan. We have a smart mix of stocks and bonds inside of our portfolios. And most importantly, we stay disciplined when our emotions can run high and can maybe push us to make detrimental decisions in the long run. And this is where we really try to live each and every day with our clients, is at the intersection of what matters most to you and what we can control through a solid financial plan, smart investment management, and of course, behavioral coaching. So to tie a bow on our update, we would like to thank you for your time, for joining us here today. Thank you so much for the trust that you place in our team, and we would be happy to answer any questions that you have.
So I'm checking our Q&A box. It looks like we haven't received any yet, but we have plenty of time, so we'll wait. Please feel free to hit us with your questions. But as we wait on the investment committee, are there any final thoughts that we didn't touch on that anybody cares to share with our viewers and listeners?
We got to thank you. You're very welcome.
I think one of the topics that has been in the news recently has been around semiconductor stocks. We saw in the first half of the year, semiconductor stocks on average up basically doubled in 6 months. So very phenomenal performance. But then since then, we've seen a rather sharp decline with one semiconductor index down about 29% as of the close of market yesterday. So it's been a very volatile asset class. And there's been a lot of reason for wanting to get into semiconductor stocks, as their growth has been phenomenal as well for corporate earnings. That's been one of the main drivers in particular for corporate earnings across the US stock market in general. But we see investor sentiment kind of shifting a little bit with the AI narrative, where investors are a little bit more concerned of all the capital expenditure, the building out of AI data centers, which of course require all the chips to be able to do that. But are those larger hyperscalers or other AI companies getting their best bang for their buck and kind of generating a profit based off of all the capital expenditure that's going in? And so investors on average over the past month have been kind of shifting their tune a little bit to be a little bit more cautious and saying basically, hey, show me the money. And if you're not, and there's a little bit of just kind of over investing as well, some kind of buying on margin as well. That's kind of pushed that looking a little bit more bubble overall market. I would say, like Carol said, not in a bubble, but there are certain areas like semiconductors that have run up so much. So I think it's definitely healthy that we're seeing that kind of extra froth in certain segments, like the semiconductor area has been kind of pushed out a little bit, which I think is healthy.
All right, Xander, I think we have a question just about international and emerging markets so far this year. Any of the investment committee want to note about international markets? We definitely zoomed in specifically on US stocks in our presentation, but any thoughts to share with our audience?
Yeah, I can share on emerging markets in particular. The theme has been very similar in terms of semiconductor chips, the AI narrative, data center build out, very similar in emerging markets as it has been here in the US. If you look at certain companies in certain countries, like Taiwan Semi, as well as Samsung, SK Hynix in South Korea, those names had done really well along with some of the names in the US. So that's been pushing a lot of the growth. As Carol was mentioning, the emerging markets up about 24% for the first half of this year. So really being the star there. There's also some concerns about kind of over concentration as well in emerging markets because of that. But overall, the growth numbers, again, has been really good on the corporate earnings side of things. And then even in international developed markets like Japan and Europe, still doing quite well as corporate earnings, not quite as strong, but moving higher directionally as well. So that's why we see really globally for the first half of this year, equities have been doing quite nicely.
Yeah, and I think the weakening of the dollar has also given a boost to international stocks as well. Wow, interesting. Thanks, Xander.
Yep.
Okay. So we received some additional questions, and so I'll read this one. What do you know about Trump money? They are saying he is going to take away money and we will just have Trump money. But I have not heard
I am
this.
not familiar with
Yeah.
Trump money. So has anybody else heard of it?
Are they talking about the $250 bill or his meme coins? I wasn't sure exactly what the question was.
I'm not sure. So if that was your question, maybe you could give us a little bit more insight specifically on what you've read or what you've heard, and we can
I
try
think there
to
was
answer.
additional clarification. It just says the government replacing currency with Trump money that we would have to use. Yeah, I definitely have not heard of that one. That would be wild to think about, but
Yeah. I would say probability of such event extremely low.
Yeah.
That of the list of things to worry about, I would put that pretty far down. There are plenty of other things to worry about, but that is not one that I would put at the top of the worry list.
Yeah. Okay, so we have another one. What are the big tech companies saying for when they expect returns?
This is interesting. So like return on investment of the AI CapEx investment is probably, I'm thinking what that question
sounds like it
means. Yeah, great question.
Yeah, I will just note again, even independent of what tech companies may be saying, I think we have to acknowledge that there are going to be winners in this AI race. And I think the majority of contenders are probably going to be losers, right? There are companies rushing into AI tech and infrastructure investment, and not every one of them is going to be successful, right? So we have to understand that at some point there's going to be an overinvestment in tech by the majority of the contenders racing along in this market. And I just think it remains to be seen who comes out as the great winner of the AI race, who again, but we are pouring literal billions, right? Companies are pouring billions of dollars into AI investment and have been over the last several years. We've even looked at GDP growth numbers, right, that have been supported by merely just our investment in AI over time. So it is a concept that we have to, I think, at some point position ourselves for the reality for that not everyone who is making the investment in that industry is actually going to be one of the winners at the end of all of it.
Yeah. And that's why I think diversification, we talk about that all the time, right? As an investment discipline. It's why it's so important because nobody knows at the end of the day who those winners and who those losers are going to be. And so if you try to, get into the individual stock picking game, we would argue that that's pretty risky. And so by having diversification in the portfolio, I think we're well positioned sort of no matter what the answer to that question is. But has
Yeah,
anyone read like specific? Oh, sorry. Go ahead, Carol.
No, we didn't show Jane's favorite graph of the quilt, how the sectors, with the diversification, just highlighting what you're saying, Anne. But as every year is just different.
Yeah.
What
Has
were you gonna
anyone
ask?
heard though? I was just going to say, has anyone heard like any companies say a specific time frame when they expect? I was reminded that Larry Page of Google/Alphabet did, I'm going to butcher his quote, but he did say something like he would rather go bankrupt than lose the AI race. So you're seeing the commitment to trying to get this AI race done there. But has anyone heard a time frame
So
quoted?
I haven't seen any, time frames. I don't know. I don't think they can foresee that either. They don't have the crystal ball, but the race is pretty aggressive. And I mentioning to you guys, there's a really interesting interview in internet of The Economist magazine interviewing Elon Musk, and he goes in more depth about this. And one of the major disruptors, of course, we see is China, which is also something that has affected, the volatility that we've seen in the chip market these past few days, mainly because China's been able to develop these large language models with less chip power than what we're doing here in the U.S. So I think, it's as Anna and Tris is saying, it's something they're going to be winners, they're going to be losers. We know this. And from our position, just being diversified and just making sure that, we're covering different markets, different sectors is the best that we can do today because, we don't have the crystal ball.
Okay, so we have time for a few more questions. So we have one. Can you explain the doping effect of military investments due to wars on the economy? And doping is in quotation marks.
Meaning that the government is spending more on defense and, stockpiling munitions again, and that creates a temporary boost to the economy. And we've seen that over the decades that when there's a war going on, that we see a boost to defense spending, and that of course is a candy to the market or a boost, a testosterone boost, to use the Department of War's term, to the economy that does seem to last for a while. The thing that's really different this time is Xander pointed out, we've had over 15,000 people laid off from government jobs. A lot of those jobs touched hiring defense contractors, bidding, those kind of things. So we may see some delay in that candy boost because there aren't all the people there doing the jobs that actually hire the contractors to fill these contracts to replace all the munitions that we're using in Iran. So it might be a delayed effect this time compared to in the past. The money started flowing very quickly. The government, Department of War still has a ton of money left that they haven't even used. So I think we're in an unusual mix of time because of so many changes happening at once that none of us can accurately predict how long something like that would last and when it would end. And once the midterms come to pass, we could see some change in policy and spending.
All right, thanks, Jane. It looks like we have about 2 more questions, which will be great because we're coming right up at the top of the hour. So this one is a fun one. Any comment on the SpaceX flop?
I know we warned folks about the once employees were able to get out there and start liquidating their shares, that we would likely start seeing some erosion of that boost that it got. And as more information about how unprofitable some of his companies have been and how he's had many flops, once as the news sort of gets out there, that's affecting that stock price, and it'll be a long time. It'll be a long time before that company's profitable. So, a lot of money is actually chasing real earnings versus hyperbole.
Yeah. One other thing on SpaceX that I think is kind of interesting, that is affecting markets in terms of earnings power. And this would be one of the caveats, I would say, for looking towards the second half of earnings growth. So Alphabet or Google years ago took an investment in SpaceX, about 7.5%, I believe, in the company. And when SpaceX went public, because of accounting rules for GAAP accounting rules, they realized, even though they didn't sell that position when SpaceX went public, because their share market price increased dramatically compared to where they had it before, it showed that Alphabet had those earnings for the last quarter. So almost $90 billion in earnings for other earnings was essentially recognized that they would have to pay taxes on, despite them not actually going and selling that whole position. And so that's going to artificially inflate earnings for a bit. So that was not represented in the data that Carol went over because it was happened after June 30th. But what you'll see is now that we're about a month later, that forward PE ratio has come down a little bit. That profit margin level has increased a little bit. And a big portion of that is because of Alphabet's stake in SpaceX. So I think there will be some kind of longer term ramifications, even though SpaceX has come down so much, over 50% from peak to trough. So I think it's also interesting to see how Alphabet's next quarter earnings, if that's going to be reflected as well on the downside, which we'll see there.
Thank you so much. And then our last question, I think we have time for one more and then maybe a note. Are there more details available to characterize consumer spending changes recently, e.g. healthcare spending, disposable income spending, et cetera? Well, I mean,
Yeah,
I
just
think
like more detail, I guess.
Yeah.
Go ahead.
I mean,
More
one of
detail
the
on the breakdown.
Yeah, one of the things I think Xander shared the expression during his portion of the presentation was about this K-shaped economy, where we're seeing behavior by higher income earners who have experienced wealth gaps that maybe don't mirror, right, what lower income earners are doing. But to that point, I think post-COVID, U.S. consumers have been, resilient in spending, even without or the sort of waning of the additional stimulus that was ejected during that period. But when we talk about specific categories, I think there are many of them that mirror just where the demographics of the U.S. consumer is going. So we see an aging U.S. consumer here. And so then we see additional spending in healthcare, right? Additional growth. Even in one of the charts, I believe that was Nihad shared, showed where wage growth is expanding by sector. And I believe one of the top sectors represented there was on the healthcare side. I think it was healthcare and education. So I do think that just because of the changing demographics of the country, we do see additional spending going there. I know many of our, listeners and viewers here today are experiencing the healthcare, to hit to their wallets, right? Higher Medicare premiums. And, now we see in the headlines changes to, Part D and what might be coming down the line with that. So I do think that we see additional spending going into those areas just because of the shifting of the demographics here in the U.S. Alrighty. And so the last little note that I'll just acknowledge, because it was more of a note than a question, was just about in relation to the Trump money question and thinking about the $1,000 per child contribution that's being offered. And so I just do want to make sure that I highlight, and we will be able to provide more information about what is being named Trump accounts for minors that became available as of July 4th of this year. But essentially, high level, it is essentially a retirement account, an IRA for minors that have contribution limits, just like traditional IRAs do. Of course, you have to have a Social Security number and be under the age of 18 to open and fund one. If a child was born between the years 2025 and 2028, for what I would say is obvious reasons, the government is making an additional $1,000 contribution to that account. There are, I believe, investments in S&P index funds that are available at the heart of them. And then, of course, once the child turns 18, contributions end, but then they still have the same sort of stipulations and penalties around why and when you can make withdrawals. So that is, of course, a high-level summary. We do have some literature that we can share with clients about those accounts in the coming months. But as always, feel free to reach out to us if you think that they may benefit you, if you have children, grandchildren, godchildren, that you are interested in possibly exploring these with. We're happy to have a more detailed conversation one-on-one.
And Teresa and I's last podcast, which was last episode, I believe a couple weeks ago, was all about, should you continue funding a 529 if that's what you're doing? Should you switch over to Trump accounts? Should you do both? So if you would like to get more information about that, check that out too on our YouTube, Apple Podcasts, Spotify, wherever you listen to your podcasts.
All right, Tim, I think
shameless plug.
We have cleared the question queue for today. We want to again thank all of our clients for taking the time out of what are very busy days to spend your lunch hour here with the investment committee. We hope that you found our presentation meaningful, thoughtful, insightful. Of course, we are always here for you every day. If you have questions or have concerns, do not hesitate to reach out. As Ann mentioned, one of our jobs is as behavioral therapists, keeping you centered and focused on the long-term financial plan and hopefully growth of your assets. So again, until next quarter, have a wonderful rest of the day. Stay cool this summer, and we look forward to seeing you this fall.